QuickBooks Pro Desktop 2021 Sales Receipt and Related Deposit. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the Open Windows open. You can open the Open Windows by going to the View dropdown and selecting the Open Windows list. We're now going to be creating a sales receipt, so that's going to be this item over here. Sales receipt being similar to an invoice, except for the fact that an invoice will be increasing the accounts receivable. We expect payment in the future. Sales receipt, you can kind of think about that form as if you're making the sale at a cash register. Someone walks up to the cash register, in our case like a guitar, and they buy the guitar at that point in time, and we record the cash or payment that was received at that point in time. So we'll record that item, and then we'll also go over to recording the deposit. Now, as you do so, you want to kind of think about what's going to happen with the financial statements as we think through this. So let's just open up the financial statements, reports, company and financial. We're going to go on down to the balance sheet first, opening up that balance sheet, entering the custom reports up top so we can enter the date range, which is 01/01/21 to 12/31/21, January through December 2021. So what do we expect to happen? We expect undeposited funds to be going up because we're going to be receiving a payment at the point in time. Someone comes up to the cash register, buys a guitar, we're imagining in the store, and we're going to say, all right, well, that means undeposited funds going to go up because it's not yet in the checking account, so we're not going to put it in the checking account yet. That's the other side is going to be on the profit and loss, so hitting the reports drop down, going to the company and financial, P&L, profit and loss, otherwise known as the income statement. Changing the dates 01/01/21 to 12/31/21, January through December. We expect then the sales to be increasing. We're going to sell a guitar, so that means the inventory sales and not the service items will then be going up. Also, if we go back to the balance sheet, we would expect then the difference between the sales price and how much we're going to receive to be the sales tax that we have to be collecting. So we're going to have sales tax going up because the government's forcing us to collect their taxes and then pay them for it. So that's that. And then we got the inventory is going to be going down. Inventory is going to be decreasing because we're on a perpetual inventory system. And then we also note that if we go to the P&L, we're going to have cost of goods sold related to us consuming the inventory in order to generate revenue. Back to the balance sheet. And then we also know that the inventory sub-account is going to be tracking the amount of units that are going to be in inventory. It's going to be going down as well. Let's do it. We're going to go over to the home page. Let's enter that sales receipt. We're going to be selling something. Imagining someone came up to our cash register, and it was Garcia Guitars. Garcia Guitars. Do we have them? I'm going to type in Garcia. No, we don't have Garcia yet. So Garcia Guitar. Typing that in there. Tab. We're going to quickly add Garcia in there. Again, in practice, we would probably want to add more detail, getting the contact information, signing them up for our newsletter and whatnot. But for the practice problem, we're going to just say quick add here. And then we're going to say it's going to be going into undeposited funds. That's the default setting. And we're just going to say it's cash. So Garcia Guitars gave us cash. And we'll keep it on, let's make it the 15th. The sales is going to be sales number 5. So that's automatically populating, so we'll keep that going as it is. Notice we don't have any billing information because we didn't enter it as we added the new customer. No check number that we're going to be adding. We're going to sell the one that he pulled up and pulled out from the shelf and brought up. Happens to be an ELP or an Epiphone Les Paul. So that's kind of like our standard sales one. We sell a lot of those. So that's going to be that one. Tab, it's going to be a taxable item. We're going to say he's just got one of those. So there it is. So what's going to happen when we record this? Let's review it again. Well, it's a sales receipt, so that means cash of some kind is going up. This time undeposited funds is going to be going up, and it's going to go up for the full amount, $525. Then sales is going to go up, but it only goes up for the amount that we actually charge, the $500. The difference between the two is what the government makes us charge in order to collect for them, and therefore the $25 is what we're going to collect and credit the payable account, which is sales tax payable. Also, we know that there's going to be a decrease in inventory for an amount not on the sales receipt because this is something we can imagine given to the customer, kind of like a receipt, and we don't want the cost on it. And so it's going to be driven, however, by this item. So the computer knows what it is. I believe it's $400, and we'll be recording it on a perpetual inventory system because that's how we set it up. And then the other side is going to be cost of goods sold, recording the expense related to us consuming the guitar in order to generate the $500 of revenue. So we'll say save and close and check that out. Save and close, checking it out by going to the balance sheet. And then we see that the undeposited funds, if we double click on the undeposited funds, we see that we have now that 525. Double clicking on that, that's the full amount of the 525, including the sales tax. Closing that out, closing this out, going to the profit and loss where the other side will be. We see on the sales side of things, double clicking the sales side of things, there's the $500. It's not including the sales tax. If we double click on that, we can see it doesn't include that $25 sales tax. Where's that $25 sales tax? Well, it's not actually sales. We're not going to record it on our sales because we're just collecting. We're just the middleman. We're just the collection. We're just being used as the collection agency by the government. So we're going to go then to the balance sheet and then go down and say that's going to be on the sales tax payable down here. Sales tax payable. Double clicking on the sales tax payable, we see that 25. There's the 25 that we owe to the government. Closing that back out, we also know that inventory is going to be decreasing. So if we go up to the inventory asset, double clicking on the inventory asset, we see $400 on the inventory asset. Double clicking on that item, no $400 on the sales receipt. How does it know to record the $400? Because we set it up with the item to know what the cost was, even though the cost is not shown on the sales receipt, because we don't want to show it to the customer in case we give the sales receipt to the customer. Closing this back out, closing this back out. The other side of that's going to be on the P&L, the profit and loss, the income statement. In the cost of goods sold here, related to or representing an expense of us consuming the asset, there's the $400 on this side as well. Net effect on the income statement, increase in sales, $500, increase in the expense, $400. Net income increases by the net of $100. Okay, so let's go back to the balance sheet. We also know that if you look at the sub account for the inventory, we sold a guitar, so it's going to be going down as well. So if we go to the reports drop down, if we go to the inventory, and then we go to the inventory valuation summary, changing the date to 12/31/21, we see our Epiphone Les Paul here. We don't have any more of those. Those are gone because we just sold the last one. We need some more because we sell a lot of those. But the total down here, 4,912, should tie out to what's on the balance sheet. Going back to the balance sheet, 4,912. Looks good. Now let's go to the deposit side of things, moving this out of the undeposited funds and then putting that into the checking account. So if you have anything in undeposited funds, that should represent cash that we're holding on to or checks that we can then, take to the bank. We want to make sure that we group them in the bank as we deposit them in the same format in our system as they will be shown on the bank statement, because we need to reconcile the bank statement to our system, which we will do in a bank reconciliation in a future presentation. So then if we go back to the home page over here, we see that we have these 3 items. That number 3, that little red number 3, means that there's 3 items that were either put in there with a sales receipt or a received payment that need to be deposited into the bank. So if we select that item, then we're going to get that pop-up window showing those 3 items. And we're imagining that we're holding on to those 3 items. They're all cash in this case. So if I go to the bank and deposit all that cash, it's going to be in the bank statement as one lump sum number. And if I put it in my books as 3 different numbers, then I'm going to have to do some work in order to tie out the reconciliation of our books to the bank. Therefore, I'm going to put them into the bank in one kind of chunk by adding them all together. And I'll put them in our books as one chunk by adding these together and say, okay, I'm going to deposit this as of the 15th again. So there we have it, the total deposit then at the 2025. That's what's going to be represented on our bank reconciliation, our bank statement, GL bank account, so that we can then tie it into what will be represented on the bank statement from the bank, which will be that same number. So let's go ahead and say save and close, save and close. Let's go back to our balance sheet, see what happens. And the undeposited funds has now disappeared. Let's look at the checking account first. If I go into the checking account, we see then we have that we have this deposit, the second to last item there, that 2025. Double clicking on that item takes us to our deposit screen once again. Closing that out, closing this out. The other side is in undeposited funds, which has now disappeared because it's at 0. We're not showing the 0 balance. So I would go to the trial balance. I like to look at the trial balance, which by default typically will have that 0. Go into the reports drop down, accounting and taxes, trial balance, changing the dates up top from 01/01/21 to 12/31/21, January through December 2021. There's our undeposited funds back to 0, double clicking on it. Note here that we're going to see the detail of the transactions. Here's the 3 transactions that we had recorded that we grouped and lumped together. So we get to see the detail, but if I double click on either one of those, we're going to see the total of those 3 transactions and the breakout, of course, on the actual form that was used there. So I'm going to close this back out and close this back out. There's going to be no impact on the income statement, even though we got the money at this point in time because we recorded it clearly in the last point in time when we recorded the sales receipt. So now all we're doing is taking money out of one asset account, the undeposited funds, putting it into the other asset account, the checking account. So here's where we stand. If you're working along with the practice problem, want to check your numbers, here's the balance sheet. So you can check your numbers on the balance sheet. And then the profit and loss or income statement. This is where we're standing there at this point in time. And then if you want to check your numbers with the trial balance, which I think is the easiest way to do so, here is where we are on the trial balance.